Good morning, and welcome to today's webcast, Streamline Tax Incentive Searches with MaxCredits Study. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning, and thanks for joining. There has been many changes to the tax law over the last several years. These changes include the addition of several key credits and incentives that are directed towards specific business activities. These are the areas where we see the most opportunity and we'll be covering today. The presenters today are all leaders in our credits and incentives practice. My name is Star Fisher. I'm a partner in our R&D tax credits practice. We have Chris LaRue, who is a partner in our tangible asset incentive services, and will be focusing on property and fixed asset related credits. We have Vanessa Oviatt, who is a leader in our R&D tax practice, as well as ERC and general credits and incentives. And we have MaryCaitlin Willcuts, who focuses on state and local tax incentives, as well as payroll related credits and incentives. Our overall learning objective is to help you gain awareness of what credits and incentives are out there for your company or could be out there. Because we have so many credits and incentives that we have to cover today, we will be doing it at a fairly high level. Also wanted to discuss the features and benefits of doing a more detailed analysis for your company of what specific credits and incentive opportunities you may have. This brings us to our first polling question.
Thanks, Star. And for our first polling question today, how familiar are you with the current tax credits and incentives programs? A, not familiar at all, teach me. B, somewhat familiar, tell me more. C, familiar, talk me through the opportunities. Or D, very familiar, thanks for the CPE. So we'll give you about 15 to 20 seconds here to answer this polling question. If you select the answer and hit the submit button, your question will be recorded for CPE credit today. right, we're almost at 90% here, so it'll be about 5 more seconds. All right, let's advance on and check out the results.
Great. Well, it looks like it is pretty evenly split between a few of these answers. So it somewhat from not familiar to somewhat familiar seems to be the most popular answer, which is great. So again, we'll be covering a lot today. So hopefully there's something that clicks with you and your company. We have bucketed the credits and incentives into these 5 categories of just business activities to help streamline the presentation. Each presenter will be taking a section and discussing the overall qualification as well as what the benefit could be. Our approach when we do a credits and incentives study is to really look at your company's specific activities by requesting some high-level information and having some interviews with key personnel. If needed, we'll request more additional information related to some specific opportunities that we see. And then you will get a detailed report outlining our methodology, findings, and next steps to claim some of these incentives. Some of them can be more complex than others. And as you will see going just through this presentation, there are a lot of incentives that can be very lucrative, but also very specific to a certain activity. And with that, I will turn it over to Chris LaRue to start our first section.
All right, thanks, Star. Hello, everyone. This first tranche of credits and incentives is effectively related to location, site selection, expansion of your company, including particularly infrastructure, if you're adding locations, going into new areas, asset intensive practice. These credits or some of these will relate to you. The Advanced Manufacturing Investment Credit we'll start with. This is from the CHIPS Act, which got a lot of press over the last few years. It's recently passed. There was news within the last 2 weeks on Intel working with the White House. They did a joint press release on getting incentives in this area. Effectively, it's a tax credit of up to 25%. When a company invests in qualified property placed in service after January of 2023, qualified property are facilities manufacturing semiconductors. You know, during COVID, there was big issues with semiconductor supply chain, most of which are done in Taiwan. And so it's an incentive to drive some of that manufacturing within the United States. So the credit's 25%. It applies to, you know, certain components of the manufacturing process. They have to be directly related to manufacturing. Those of you familiar with the other tangible property rules, which relate to being integral to a manufacturing process, that's really what this is aimed at. The exceptions, you know, it can't be offices or administrative services or non-manufacturing purposes. There's some limits on it, overlapping with other credits. Identifying whether it's integral to the operation, the other tangible property is somewhat complex, so it does require quite a bit of analysis. I think Intel's investment in qualified property, they were figuring was going to be about $100 billion, so, you know, potentially very lucrative for major investments. New Markets Tax Credit, this is a federal incentive as well. It's been around for a lot longer than the other one. It stems from the Community Renewal Tax Relief Act of 2000. The goal is to, you know, incentivize investments in, you know, traditionally lower income urban and rural communities that maybe have lacked a lot of investment historically. That's really where it aims at. It's pretty broad in what it applies to. Commercial buildings can have not-for-profit, including financing, just incentivizing investment in certain areas. The benefit's a 39% tax credit, and that's spread over a 7-year period. That's a total of 39%. It's not an annual one. Spread over a 7-year period. That's a big benefit. It also helps companies with ESG metrics and incentives. Financial institutions are very active in this, can help with their Community Reinvestment Act requirements. The qualifications could be businesses or not-for-profit in the low-income census tract or serving low-income persons. The project requires the establishment of it's called a qualified active low-income community business. And that business has certain requirements over a 7-year compliance period. There's threshold requirements with respect to investments. There's also regulations. And then there's businesses that are excluded. Golf, gaming, generally leisure businesses aren't eligible for the tax credit. Enterprise zone credits are a state system, so this isn't a federal credit. It's for specific states. Not all states have enterprise zones. The ones currently that come to mind, Oregon, Colorado, and Texas, will have an example of the Texas enterprise zone credit. California had one that expired. It's somewhat similar to the new markets. It's generally related to incentives for investing in certain enterprise zones that are established by a community and approved by the state. How they're focused on that, it's economic distress of an immediate geographic area, local efforts trying to achieve development and revitalization of a community. There might be private efforts to bring up wages. The commitment level and the goals are really a big part of how communities get nominated for this. Some of the thresholds, they're meeting minimum capital investment and also creating jobs. It's really focused on those two items. Also, just a note, the incentives can be state income tax, it could be sales and use tax incentives. They're not all uniform. It really does vary by state. The example below and on the next slide is for Texas, just to give you some idea of what it may look like if you're expanding into an enterprise zone. So for Texas, they have, if the project's located within a designated enterprise zone, 25% of the employees must be economically disadvantaged or residents of the zone. If it's outside of the designated enterprise zone, then 35% of the employees must be economically disadvantaged or residents of the zone. So just an example of some of the thresholds. Again, for Texas, it's a sales and use tax refund. And use this as an example. If you're expanding into other states, this is definitely something to look into within that state. For Texas, the focus on job retention and creation, that's not novel. It's pretty similar with other states. They want capital investment. They have a per job refund of $2,500 on the low end and up to $7,500. It's a 5-year validation period. There's certain application requirements and fees to apply. That's enterprise zone credits. Fixed asset classification. This might be a more well-known incentive. Cost segregation. Now, unique from the others, this isn't a tax credit. This is a tax deferral strategy. So a deferral of income tax, cash flow play. It involves a review of fixed assets and for cost segregation, real property transactions. So think leasehold improvements, ground up construction. If you're acquiring a facility, any significant real property transaction. How it differs from your normal preparation of a tax return, it's a thorough review of invoices, They look at building and construction documents, the generally more significant real property transactions. It's what's referred to as an engineered-based study. So they'll look at invoices, and when the costs aren't available, I should say will, not they'll, I do this. When the costs aren't available, you do estimates of them through the plans and create a report. The purpose is to accelerate your depreciation. You're reclassifying assets into shorter depreciable lives. So, you get the cash now versus in the future. Another value is it assists in identifying any special depreciation allowance, 179 expenses, or federal bonus depreciation, which for 2023 is 80%, and in 2024 it goes down to 60%. So identifying assets that are eligible for that, it's a pretty significant incentive. There's also a bill to make this back to 100%, so we're keeping an eye out for that. There's a compliance component. Repair and maintenance expenses sometimes get bundled in this and get capitalized. So if you're in a high tax state like California or New York, there's an additional incentive that may not comply or conform to bonus depreciation. There's an additional incentive to identify things as repair and maintenance expenses. It applies to virtually all types of facilities in a for-profit environment. Manufacturing is very popular in this area. Real estate, obviously, restaurant, retail. As I mentioned, the studies can be formed any type of significant real property transaction, ground up acquisitions, if you're expanding, renovating. That's really where the repairs could come into play if you're renovating an existing building that you've owned or occupied for a while. Leasehold improvements, whether they're paid by the tenant or the landlord, and that would be for the tenant or for the landlord. You would need to have basis, so you'd need to be spending the dollars. Landlords sometimes will do tenant allowances, and you can do a cost seg on the tenant allowance contribution, assuming the landlord has basis in the assets. General thresholds, these aren't hard and fast rules, but just some parameters. $1 million of depreciable basis for newly constructed or acquired building. That's usually not hard to get to. Leasehold improvements with the bonus depreciation, it can be as low as $300,000 because there's a provision currently where certain real property can be eligible for bonus depreciation. So of the $300,000, sometimes it's worthwhile to do a full study for threshold even that amount. And you can apply this retroactively, so you can go all the way back to the beginning of the Maker's Rules, which is our current depreciation system, which was established in 1987. It's a tax deferral, so the more recent the transaction, the bigger the benefit. We probably wouldn't recommend someone going all the way back to something that occurred in 1987, just because the deferral period would be so short. Another incentive similar to, it's not really a credit, it's more of a due diligence, is property tax reclassification. And this is an analysis of asset lives and classification to reduce your property tax assessment value. It's going to be more relevant for capital intensive businesses. There's some examples here: manufacturing and leasing, transportation, businesses that are expanding and moving into new states, because the rules between federal and states can vary, and getting a handle on that can be complex. Property taxes get assigned to all kinds of things: real property, personal property, certain inventory, and finished goods. So it's pretty vast on where they can get applied. The key component is just reducing what could be an inflated tax assessment. Some more common examples: if you have assets on your books that have previously been disposed, they're technically not assessable, but it's just a matter of keeping that record. One downside of bonus depreciation, disposing of assets on your books for tax purposes isn't as beneficial, because it could be a fully depreciated asset after 1 year prior to 2023. But there would be a property tax component where you'd want to make sure that asset's no longer on your books and not currently being assessed. Idle equipment, bundled assets, another example, repairs and maintenance that may be recorded as a fixed asset in your system. Again, there's some overlap with the cost segregation and fixed asset review there, where you could solve both issues on properly classifying something as a repair and maintenance. So it's one, you get the deduction, and two, it wouldn't be assessed for property tax purposes. Certain equipment that's off-site, idle, some intangible costs, a lot of things to make sure these are the ones that can be potentially inflated. There's two really key challenges and requirements. Is the rules for state and local property tax can differ from federal income tax definitions. Important to keep in mind. The result could be over-reported costs and duplicate assessments, different rules. Also, the second challenge is with state and local property tax rules, they could be changing, constant flux. So keeping pace with that could be a challenge as well. So that this service is really related to, properly identifying and making sure you're only being assessed appropriately. And off to MaryCaitlin.
Perfect. Thanks, Chris. Okay, so now we're going to pivot and talk about some job creation, hiring, and wage-based credits. The first one is the employee retention credit. So this incentive came out as part of the CARES Act. It's a fully refundable payroll tax credit for employers who had either a significant decline in gross receipts or a full or partial suspension of their business operations due to U.S. government orders mandating closures. Qualification is not straightforward. It does require a significant amount of due diligence in order to determine that a business meets the requirements. Audit risk is also very high with this program. So it is really important that employers are adequately applying the facts and circumstances of what occurred to their business during COVID and applying that towards the IRS guidance to effectively determine if there is reasonable position. Where the program stands today is a little bit unknown. So statutorily, the program for 2020 credits expires April 15th of this year, and the 2021 opportunity expires April 15th of next year. However, in January, a provision was included in the tax bill to terminate the program entirely, effective January 31st of this year. That provision, it passed with the House, then it went to the Senate, and it has not moved. It's not really expected to move at this point, but there are rumors that the provision could potentially be added on to a separate bill at a later date this year. In addition to this, since September of last year, the IRS has been in a moratorium. And as of right now, there's no clear indication on when that moratorium will lift. So any refund claims for this credit that have been filed since September of last year are not being processed and will not be processed until that moratorium lifts. Another program is the Work Opportunity Tax Credit. So this is a great program for businesses who might be hiring certain individuals that are on government assistance. Specifically, businesses that hire minimum wage, non-highly skilled workers tend to see larger percentages of qualification. The program does require employers to implement a process to capture qualified applicants or new hires and then file applications with state workforce agents. Those agents are the party that verifies and certifies the qualified new hire so that the employer can take a tax credit on the wages paid to that individual. Despite kind of the administrative requirement, there is ways for businesses to be able to take advantage of this without burdening their HR or hiring teams. And primarily that's through outsourcing this to a third-party provider who can facilitate and take on the administrative aspects of this program so that the business can continue to operate as normal and generate tax credits based on the demographic of individuals being hired. To kind of determine and understand, what qualification means for these new hires, the program is really targeting specific forms of government assistance. So by hiring these individuals, they no longer need that government assistance to become self-sufficient, and then the business can generate that tax credit. So some examples of areas of qualification can include individuals who are receiving state or federally funded disability rehabilitation, unemployment, food stamps, felons. There are a variety of target groups for veterans, but those are, again, specific to veterans receiving forms of government assistance. The credit is a percentage based on the amount of wages and hours a qualified new hire works. And so depending on their retention and what their average annual pay is, the credit amount can range, but in general, the maximum credit amount ranges from $2,400 to $9,600 per qualified employee. Another great program is the Empowerment Zone credit. So this is tailored towards businesses who have a physical location in a federal empowerment zone, and they are also hiring individuals who live within that same federal empowerment zone. Zones are located really all over the United States, but primarily empowerment zones reside in kind of the Midwest region. There are a few on the west side of the country. So California has some empowerment zones in areas like Fresno, Los Angeles, Santa Ana, the Joshua Tree area. So there are some opportunities on the west side of the country, but primarily they are in the Midwest. And the size of the zones can really differ. In some jurisdictions, it could just be a couple of city blocks. In others, it could be a few mile radiuses. It just really depends on the jurisdiction and what's been declared a federal empowerment zone. The nice thing about the Empowerment Zone program is once you've hired a qualified individual, as long as they continue to live in the zone and continue to provide the majority of their services at a location in the zone, a business can continue to take the credit on that individual each year that they continue to meet those requirements. Another opportunity that we'll briefly discuss, because it's not exactly an active program currently. So this program, it's a disaster employee retention credit, but it is completely separate and distinct from the COVID-related employee retention program. This is for businesses who have a location in an area that's been hit by a natural disaster, and the area has been deemed a federally declared disaster zone. So hurricanes, wildfires, earthquakes, tornadoes, those are types of things that can occur that can impact the ability for your employees to work at their location. And by retaining those individuals and paying them, a business can get some relief with a tax credit on a percent of the wages. As of right now, the program is available for tax years through 2020, but it is anticipated that this will come back for future years. It's been around for a long time, so we do anticipate this becoming an opportunity again in the near future. Another opportunity is the employer credit for family and medical leave. So this is a unique program where it's incentivizing employers who are in states that do not have a mandated paid leave program. So for an employer in a state that does not require that they provide a paid leave, if that employer chooses to voluntarily provide a paid leave program, they can get a tax credit on the wages paid to the individuals while they're on leave as a valuable benefit opportunity. The program does require that an employer have a very specific type of policy in place. So there are parameters that are needed to be met for an employer's policy to qualify. But once you have a qualified policy, the amount of credit that you can generate is determined by the percent of wages you pay to employees while they're on leave. So in the table you see on the screen here, if an employer provides 50% of wages as the leave benefits for an employee, then they can generate a 12.5% credit on those wages. If they provide 100% paid leave, then it's a 25% credit. So the more generous of the paid leave, the more generous of a credit they can get in return. So those were all different types of federal programs. Now we're going to talk about some state-specific hiring programs. There are a number of states that have programs that encourage employers to hire certain individuals based on various parameters. We're going to go through just a few quick examples of some states and programs that they have. So Alaska, they have a program specific to hiring types of veterans. Arizona has a new employment credit, as well as a program for hiring individuals who are receiving family aid. California has their California Competes credit, as well as a new employment credit. Colorado has a job growth incentive. Illinois has a program for hiring felons from the state. And lastly, an example, New York, they have a program for hiring certain veterans as well as for hiring individuals with disabilities. So depending on different states and the demographic of individuals you're hiring, there could be, in addition to these federal programs, some state level programs as well. All right, now we're going into our next polling question, and Chad, I will pass this to you.
All right, we have our second polling question of the day. Is your company interested in learning more about job creation, hiring, and/or wage-based credits? Either A, yes, B, no, or C, unsure, not applicable. So we'll give you about 15 to 20 seconds or so here to answer this polling question. If you select the answer and hit the submit button, your question will be recorded. All right, we'll give you about 5 more seconds here. All right, let's advance it on to the results.
All right, so it's kind of a mixed response. But yeah, for those of you who are interested in learning more about these, we're definitely, happy to chat, reach out to Moss Adams Contact, and be happy to talk more about the different types of opportunities. So now we're going to pivot into some other types of state incentives that are not specific to hiring and wage-based. So some other types of incentives that might be available at the state level could be cash incentives. So this could be, discretionary grants for, job creation and retention, capital investment, infrastructure assistance, permit impact fee waivers, and different types of equipment replacement grants. Another type of incentives are tax incentives. So this could be income franchise tax credits for capital investments and targeted activities, sales and use tax refunds, real and personal property tax abatements, research and development credits, gross receipts tax credits, different things like that. Also training benefits. So training cash grants for reimbursement of training expenditures, training tax credits for different types of qualified expenditures, in-kind services, costs, assistance with curriculum development. There are also financing incentives, so tax increment financing, forgivable loans, new markets tax credits, which Chris touched on, tax privileged enterprise zones, different types of things under there. And then, more commonly heard of these days, green initiatives. There's a big push for green initiatives. This could include things like stimulus funding, utility rebates, energy efficiency credits, credits and grants for investments in renewable energy, property, pollution control tax credits, recycling tax credits, etc. There are a number of different types of opportunities. The last opportunity I want to talk about are transferable tax credits. These may or may not be widely known within the audience. So transferable tax credits, they're a great opportunity for certain taxpayers. These are credits that can be transferred to another unrelated party to offload either unusable tax credits or to acquire credits at a discounted rate to help offset certain liabilities. In general, transfer prices, they can range from various amounts depending on the jurisdiction, the type of credit, type of taxes the credit can be used against, et cetera. There's a variety of different facts that can influence the transfer price. Historically, this has been applied to state level credits, but more recently under the Inflation Reduction Act, it can be done at the federal level as well. So some examples of the types of credits. So at the federal level, you've got investment tax credits or production tax credits. And at the state level, there's things like film credits, affordable housing development, historic rehabilitation, renewable energy products, different things like that. There's a variety of benefits to transferable credits, but most notably is that ability to buy credits at a reduced rate to offset that tax liability, or for taxpayers to be able, who generated credits that they can't use in a certain jurisdiction, then being able to sell those for profit kind of helps out both sides of the party. Okay, we're going to pass to Vanessa.
All right, thanks so much, Mary-Caitlin. So I'm going to be speaking about clean energy credits and incentives to start with. So many of you have probably heard of the Inflation Reduction Act. This was something that came about for 2022 and was put into place by President Joe Biden. It's commonly referred to as the IRA, so I'll be speaking about it in that way, but it's the largest ever commitment by the U.S. to fight climate change. So this is coming in the form of almost $400 billion in tax incentives, which is aimed at reducing carbon emission and accelerating the country's transition away from fossil fuels. So there were already some existing clean energy incentives, but the IRA expands the scope and the value of those existing incentives, and also created new ones that companies kind of both in the renewable energy and fossil fuel sectors will find beneficial. So we're going to be talking about various incentives, and it's going to be at a very high level, but there were some key terms that I wanted to address. So the first is going to be the prevailing wage and apprenticeship requirements. This is going to essentially what it is the Department of Labor determines wage rates for different laborers. These are going to be the people that are, potentially involved in the construction of a facility. And then there's also apprentices that are part of a registered apprenticeship programs that need to meet certain hours. So that's all going to be defined. There's documentation requirements related to that. But if you meet those requirements, you can get an enhanced credit benefit, which I'll talk about. There's also bonus credits. And so these can be available if projects are in energy communities. An energy community relates to kind of brownfield sites. So it's sites that used to be, for commercial or industrial purposes. And that could be an enhanced bonus credit of 10%, which I'll talk about as well. And then if you meet domestic content requirements, which essentially all the components that you're producing are made in the United States, you could get another bonus credit of 10%. And so we'll be talking a little bit more about where these prevailing wage requirements and bonus credits are applicable. MaryCaitlin mentioned the transferability of credits. So this is also something that is new for these energy-related credits introduced by the IRA. So we'll be talking today about renewable energy generation tax credits. I've listed out here the ones that were already here previously and the new ones as well. Carbon sequestration tax credits, as well as clean fuel tax credits, clean vehicle tax credits, and energy manufacturing tax credits, and then the energy efficiency tax deduction. So we'll be going over all these at a very high level. So I'll pass it on to Chad for our next polling question.
Awesome. Thank you, Vanessa. And our third polling question for the day, which clean energy credit or incentive are you most interested in learning about? A, renewable energy generation tax credit, B, energy manufacturing tax credit, C, energy efficiency tax deduction, D, clean vehicles tax credits, E, clean fuel tax credits, or F, carbon sequestration tax credits. And I'll give you about 15 seconds or so here to answer this polling question as well. And just a reminder again, you can submit your question by selecting the answer and hitting the submit button. All right, we'll give you about 5 more seconds here on this one. All right, let's move it on to the results.
All right, great. Still probably a bit of a mixed bag here, but renewable energy, energy manufacturing, energy efficiency tax credits, so the deduction. So yeah, we'll be talking about all those today. So the first group of credits is going to be the renewable energy generation tax credits. So we're going to start with Section 45, which is a production tax credit. So this is a production tax credit, which is for electricity that's produced from certain renewable resources and sold to unrelated parties. So this is something that already existed prior to the IRA, but the IRA expanded the scope of it. So the renewable resources that qualify for this credit usually include wind, biomass, geothermal, hydropower, municipal solid waste, marine and hydrokinetic energy. The IRA actually also included solar power, so that's just a new opportunity that expanded the scope. As I had mentioned previously, there are prevailing wage and apprenticeship requirements as well as bonus credits that are applicable to this production credit. At the base level for the credit, it's going to be the $27.50 per megawatt hour in 2022, and this is adjusted for inflation and if you're meeting the prevailing wage requirements. If you happen to meet the bonus credits for being in an energy community or meeting domestic content, you could potentially increase your credit to about $33 per megawatt hour. So again, incentives are there. They want companies to be investing in this for clean energy, and so the credits are pretty lucrative. The second credit here that has also been around for a bit is the investment tax credit. So similarly, rather than producing the clean energy, now it's investing in the construction of a new energy property. One thing about this investment credit that the IRA did was expand to batteries or energy storage technology. This is also applicable to costs for the interconnection property or installation of that energy property. The base credit is actually 6% of your energy property, And right here, this credit benefit is showing the increase to 30% of your basis energy property if you meet the prevailing wage requirements. So again, it's very, lucrative for the business if they're able to meet those requirements and those documentation requirements. And then similarly, there, also the bonus credits and that you can get from the other credit for the production. So these are the two that have been around for a bit, and these will eventually sunset. So now, as you see, there's two new credits, 45Y and 48E, which again relates to the energy, electricity production, and the investment credit. So the ones I spoke about before for 45 and 48, those are going to be sunsetting in 2024. So these will be applicable starting in 2025. Again, very similar, but it's going to change your credit benefit to $26 per megawatt hour. And then, that 30% basis, like I said, both of these are if the prevailing wage requirements are met. And then eventually this will be a phase down in 2034. One thing to note here is that the taxpayers have to choose between the production credit or the investment credit. And so typically when an opportunity comes to us, we assess which is going to give you the higher credit benefit, since you can only take one. The next credit is the 45U zero emission nuclear power production credit. This one has been around, but it's qualified nuclear power facilities that are taxpayer owned facilities that use nuclear power to generate electricity. That, for one, didn't take any prior credits. So like I said, there were clean energy credits that were available previously. So as long as you didn't take a credit before, you could be eligible. And then you also have to be an existing nuclear power facility prior to the enactment of the IRA. So this is for nuclear power facilities that were already in service. So the production credit amount would be about 3 cents per kilowatt hour. And then eventually there's going to be a phase down as you reach that annual average electricity prices that exceed $2.05 per kilowatt hour. And again, as you can see here, if you meet the prevailing wage and registered apprenticeship requirements, you'll be eligible for that credit that's 5 times that, so up to $1.50 per kilowatt hour. All right. Next is the 45Q carbon capture and sequestration credit. So under the current law, the industrial carbon capture or direct air capture facilities that begin construction prior to 2032 can qualify for this credit. It can be claimed for carbon capture during a 12-year period after the facility is placed in service. And then the credit is computed per metric ton of qualified carbon dioxide captured and sequestered. So again, it's a very specific type of activity here that we're talking about for this credit. But here is a bit of a snapshot of what the credit benefit could be. Here we kind of just show just the different rates that have changed from the previous law and where it's going to now. So again, just an increased credit benefit that was expanded by the IRA. All right, so clean fuel tax credits. So here are the 3 clean fuel tax credits that are available. 45V clean hydrogen production tax credit. Again, qualified production of clean hydrogen. Again, prevailing wage requirements that can be met there. The 40B sustainable aviation fuel tax credit is a new one as well for the sale or mixture of sustainable aviation fuel. This one's only available for 2023 and 2024 under this blender's tax credit benefit, but this will sunset in 2024, and then starting after that, there's the clean fuel production tax credit. So again, it's still for the sustainable aviation fuel, and that'll be available until 2027, and there's just a shift and a change for what the credit benefit will be. But here's a recap of what all those benefits can be for clean fuel tax credits. Next is the clean vehicles tax credit. So this is going to be for alternative fuel refueling property tax credits. So this is essentially, the best example is just a electric vehicle charging station. So, if you're putting those, whether it's part of your business or in other areas, to incentivize people with electric vehicles to be able to travel and get their vehicles powered, this could be something that could be beneficial. So qualified alternative fuel includes any fuel, at least 85% of the volume, which consists of the following, ethanol, natural gas, liquefied petroleum gas, hydrogen, and it's also any mixture that consists of two or more of the following. So biodiesel, diesel fuel, or kerosene. So this is something that can, be beneficial as another credit and has the prevailing wage and apprenticeship requirements as well. So you get 30% of that cost basis back. All right. And then there's the actual clean vehicles tax credit. And this is applicable to, the commercial fuel cell vehicles. It's any clean vehicle that's placed in service by the taxpayer. This is available starting after December 31st, 2022 through January 1st, 2033. The credit is computed, it's either going to be the lesser of 15% of the vehicle's cost or the incremental cost or the excess of the vehicle relative to a comparable vehicle. It does get capped out at $7,500 for a vehicle that is less than 14,000 pounds and $40,000 for those that exceed 14,000 pounds. Next, energy manufacturing tax credits. So right now, this is where we've seen probably the most opportunities. There's essentially the advanced energy project credit. So this is going to be defined as a project that either re-equips, expands, or establishes a manufacturing facility for production of various types of renewable or clean energy. So solar, wind, carbon capture, electric vehicles, and their components. And this, whether it's an existing facility or a modified facility, you could be potentially eligible for this credit. And again, you can get up to 30% of the cost. So 45X is where you're seeing again, it's a new production tax credit, but it can be claimed on the domestic production and sale of qualifying solar and wind components, and also includes batteries. So, these are going to be eligible components that are solar energy components, wind energy components, inverters, battery components, and other critical minerals. The one thing to say here is that you can't get both the 48C Advanced Energy Project Credit and the 45X Manufacturing Production Credit. So again, this is a situation where we would analyze what's going to give you the bigger benefit, and then decide which credit to go after, because you cannot take both. This something to note here is that there is a transferability opportunity for this. We can transfer the credit to an unrelated party, but direct pay is also a unique opportunity here because any eligible taxpayer can elect direct pay during the first 5 years of the credit. So, whether it's just you're a project owner, it could go directly to you. Or it could be a company that's, doing this, but it's just another unique opportunity here for this credit. And lastly here is the energy efficient commercial building tax deduction. So this is for tax deductions that are beginning after January 1st, 2023. Eligibility is going to be around commercial building owners, designers of buildings, as well as real estate investment trusts. There is a tax deduction range. So there's going to be the base deduction. So that's going to be on a sliding scale of 50 cents per square foot for energy savings of 25% and up, and up to $1 per square foot for energy savings of 50% or greater. There's also a bonus deduction, as you'll see here, if you meet the local prevailing wage and you meet the apprenticeship percentage hours for up to 50% of labor hours. So again, there's documentation requirements around the prevailing wage and apprenticeship. That's something to just keep in mind. Again, you can see here, that's just an enhanced credit benefit. And there is a deduction cap for this credit. This leads us to our next polling question.
All right. Thank you, Vanessa. And our fourth and final polling question of the day. Are you familiar with the benefits of claiming the R&D tax credit? A, yes, we are currently claiming the R&D tax credit. B, no, but we're interested in learning more. Or C, unsure, not applicable. So I'll give you about 10, 15 seconds to answer this final question here. You just select your answer and hit the submit button. Give you about 5 more seconds on this one. All right, we're going to move it over to the results.
Okay, great. So this is the transition where we're going to be talking about the R&D tax credit. So, the R&D tax credit is for U.S.-based activities only. Foreign research activities aren't eligible. But this is essentially a dollar for dollar tax savings that directly reduces your company's tax liability. There's no limitation on the amount of expenses that could be eligible for the credit. There is, an opportunity, if you haven't been claiming this credit, to be able to go back 3 years and amend to claim it. And there's also state opportunities for this credit as well, which some of them actually being refundable. Here are kind of the high-level benefits of this credit. You're going to be able, like I said, to offset your tax liability for your company. And we're either looking at gross receipts or your qualified research expenditures. Usually there's a look back period to establish your base threshold for your credit calculation. So if you haven't been claiming this, please know that there are documentation requirements around claiming a current year credit, and you also have to look back a few years. But a big opportunity comes in the form of a base for payroll tax credit offset. So these are for companies that have less than 5 years of gross receipts, as well as less than $5 million in gross receipts. Right now, the payroll credit maximum is $500,000 for 2023. $250,000 of that can actually offset your FICA or Social Security tax, and then the remainder can offset Medicare tax. So pretty large opportunity if you're eligible. So this is mostly going to, a lot of the time, the companies that do this are ones that are pre-revenue, in a taxable loss position. And so they are able to take advantage of this credit to offset payroll taxes that, every company has to pay. So if you think that you're fall and, meet the eligibility criteria, this could be something very beneficial. So there are essentially 4 categories of qualified research expenses that could potentially be eligible. The big one that we typically see is going to just be the wages of your employees that are involved in those research and development activities. Computer leasing costs include cloud computing. This is, if you have any software component, AWS or Microsoft Azure is usually what we see there. Supplies or materials that are used and consumed during the research, and then contractor payments. This is an example of just some of the different types of activities that we typically see in manufacturing and consumer products. And I wanted to close with one more credit here, which may or may not be applicable to most people here, but it's the orphan drug credit. So this is usually for pharmaceutical companies that are working to find cures for certain rare diseases that affect small populations. It's very similar to the R&D credit, but you're actually getting 25% of clinical testing expenses back as opposed to 10% of qualified research expenses. But again, this is for a very specific type of activity. But in closing, those are all the credits. So I will pass it on to Chad for closing remarks.
Thank you, Star, Chris, Vanessa, and MaryCaitlin for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck in a handouts window. If you participated as an individual and met all certification requirements, your certification is available for download now in the CPE progress window. I'll keep the webcast open for a couple minutes and give you time to download your CPE certificate. A copy, though, will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this, as your survey feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.